Hi guys, welcome to my channel Investing Untangled. Today in this video, I'm going to be breaking down complex financial terms into simpler language for you and show you how you can very quickly and efficiently analyze stocks and see if they fit into your portfolio. I'm myself a value investor and I'm always looking for companies that have shown very consistent and stable record of increase in revenues and net income and have shown very strong cash flows. Those are the companies we should all be interested in, and I also run my own valuations to figure out what kind of a buy price I would want to pay for them. I'll share all of that with you in my analysis here today and in the upcoming videos. So let's jump right into the analysis now. Okay guys, let's check out how you can analyze stocks for investment. There are 3 steps to it. Step 1 is quantitative or fundamental analysis, where you look at financials, future growth prospects, leverage, etc. Step 2 is assessing valuation, where you want to figure out what kind of a price you want to pay for this business. And step 3 is qualitative analysis, where you want to understand the business model in detail. You want to assess the competitive advantage that the company is having, and you want to evaluate the work that the management team is doing. So in this video, we'll be discussing quantitative or fundamental analysis. So I'll show you how you can financially analyze a company quickly. And in my next 2 videos, I'll be showing you how to assess valuation and how to do qualitative analysis. Okay, so quantitative or fundamental analysis, I generally look at the big 5 numbers to start with, and after that I check returns on investment, and then finally I check the financial health of the company. So we'll start with the big 5 numbers, and those are revenues, net income, equity, which is also called stockholders' equity or book value per share on a per share basis, operating cash flow, and free cash flow. So I'll define these terms here very briefly. Revenues is basically the total sales, so money that comes in by selling products or services. And net income is the profits that are left after expenses and taxes are paid off. And stockholders' equity or book value per share is basically total assets minus total liabilities. So what are the assets that a company has, subtracting from that total liabilities such as loans, etc., and then what are you left with, and this can be obtained from the balance sheet. Then there is operating cash flow. It is basically cash flow generated by a company's business, and this is obtained from the cash flow statement. And finally, we have free cash flow, which is operating cash flow minus capital expenditure. Capital expenditure is expenses that are spent on, so money that is spent on maintaining buildings, buying new equipment, etc. So basically maintaining the business. And the leftover money is basically called free cash flow, and you want to analyze what is basically the free cash flow, and this gives you an understanding of how much of a cash flow the company is generating. Okay, so here for an example, I'll analyze Google today, and we'll check out what's happening with Google in terms of its finances. Okay, now we'll look at these big 5 numbers from Google in the last 10 years. And this data you can obtain from Morningstar, and you can see that Google has been doing actually really well. It has been consistently growing all 5 numbers. So revenues, net income, book value per share, operating cash flow, and free cash flow. All of them are going in the right direction. They're all increasing, and revenues went from 29 billion to 171 billion. So TTM is trailing 12 months, meaning the last 12 months. And you see all these numbers are significantly higher than what Google earned in 2010. So this leads us with a compounded annual growth rate for the revenue at 19.33% and compounded annual growth rate for net income at 15.43%. So these are great numbers. Okay, the next thing we look at is returns on investment, and we look at ROE, which is return on equity, or ROIC, which is return on invested capital, to assess returns on investment. And I like to see numbers of around 15% or above. The higher the better. And you can see for the last 10 years, Google has had ROE of around 15 to 20% consistently, and ROIC also has been around between 14 to 18%. There have been years like in 2017 it dipped a bit, but overall it has stayed stable within this range, which is very, very good. Okay, finally, the last thing we look at is the financial health of the company. So now that we have figured that the company is growing our big five numbers and the company is doing a great job at getting great returns, 15% or above, we now want to look how is the financial health of the company doing. And for that, we have to check the current ratio and the debt to equity ratio. Current ratio is the ratio between the current assets and the current liabilities. So it should be 1.5 or above. And debt to equity is the ratio between the total debt and equity of the company, and it should be 0.7 or below. And as you can see, for Google, the current ratio is 3.41, which is very, very high, much higher than 1.5. And Google's debt to equity ratio is 0.12, which is much lower than 0.7, indicating that this company is financially very, very healthy. So here I've got the ratios, current ratio and the debt to equity ratio for the last 10 years for Google, and you can see that the current ratio is constantly above 1.5. It's actually much higher than 1.5 for all the years. And debt to equity, where my threshold is 0.7, and Google has maintained this ratio much less than 0.7, which actually indicates that Google has had a phenomenal financial health all over. So it is one of the strongest, financially, it is one of the strongest companies in the world. So to sum up my analysis, I like to invest in companies that have consistently grown their big five numbers over the last years, that have had returns on investment of around 15% or above on both ROE and ROIC, and that are financially very healthy, and their current ratios are 1.5 or above, and debt to equity ratios are 0.7 or below. And these are the companies that I'm inclined towards and that I invest in. So in this video, I showed you how to do really quick quantitative or fundamental analysis of a stock. In the next two videos, I'll be discussing valuations and doing the qualitative analysis of a company to get a holistic picture of the finance of the company and if it is a good investment or not. So this pretty much wraps up the analysis part of this video. Thank you guys for sticking around until the end of the video. This pretty much wraps it up, and I'll see you in my next video. Please consider leaving a like and subscribe to my channel, Investing Untangled. I'll be posting a lot of stock market research in my upcoming videos, and I'll see you in my next video.